you guys right now. It's about 1190, the difference between a 15 and 30.
Right, so we'll go over quickly how I got the 1190, what that would look like if you go into a 30 year, if you make an extra payment, and if you invest, how much you're expected to make, and also how much you're going to be paying in interest, the differences between a 15 and a 30 year. Let's look at a couple examples. So the first thing is here on bankrate.com. These are the general interest rates, not specific. They do vary when it comes to credit. These are for a 30-year 6.52 if you see here in the blue, and for a 15-year fixed, it's going to be a 5.91 in the green. From bankrate.com, once again, it does vary from lender to lender, and if you buy down the rates, right? So let's look at our first example here, based off of a $700,000 loan on a 10% down payment and a 6.52% interest rate. This is going to be included taxes and insurance. Here is for the local here in Orange County. We've already calculated this. Looking at the $700,000 loan with that 6.52%, right, where we got it here, the very general interest rates, right, mortgage interest rates. It's going to be a payment of $51.60 over 30 years. This is the total investment that you'll be making if you make that payment every month for the next 30 years. And then let's ignore this 20% down. Let's go look over here at the blue with a 15-year mortgage. Like I said earlier in the video, you'll get a favorable interest rate because you're going to be paying it back much sooner. Your payment does jump up to a $63.50, and you'll be saving around $500,000 if you're able to make this payment for 15 years. And where I got that interest rate, that 5.91, right, back over here in the green for a 15-year 5.91. So this is how it looks for these two different payments, a 30-year and a 15-year. Now quickly, where I got the differences between these two, right? I've already calculated here $63.50 for a 15, and then for a 30-year $51.60. The difference is $11.90. Now I want to go over the extra payment and as well as what you can do with this, the leftover after you make that extra payment, how much you'll save in interest, and how much earlier you can pay off your home, and as well as what you can make if you invest that into an IRA or a 401k. Let's go quickly over the next example of making that extra payment. So based off of the same example, $700,000 loan, 10% down payment, and if you were to just minus 650 off of that 1190 for that 30-year mortgage, right, the difference between a 15 and a 30, you're left with 540 that we'll use to invest. Let's put that to the side now. So that's 650 for a 30-year mortgage, the difference, right? If you make that extra payment every month, you'll actually pay off your home 9 years and 6 months sooner, and you'll be saving around $290,000 if you make that extra payment and go with the 30-year instead. Now let's go over the next thing. Based off of the average return of the stock market, right? You're expected to make around 7 to 10%. Some years less, some year more. I'm not a financial advisor, but this is based off of Google and some pretty credible websites, right? You can look it up yourself. I'm not a financial advisor, but you can get this off of credible sources. So 7 to 10%. Let's be conservative and let's go over to the calculator. This is basically just any generic calculator that I put in here, and where I got that 540 here is the leftover of the 1190 going with a 30-year mortgage, right? You'll be left with 1190, and then we minus the 650 because this is the extra payment. You'll be left over with 540. The max contribution for 2022, I think it was 6,000. This is the automatic input, but I believe for 2023 they're going to be raising it to 6,500, but double check yourself. But for this example, we're going to be starting off with 540, which is the difference, right? Then if you start at 25 years old, which is pretty typical for people who get out of college and they want to get a home and they're thinking, should I do a 30 or a 15? Let's just say you start at 25, and this is long term, right? And you see the numbers here for the next, 35 or 40 years. If you were to continue to make that payment and start at 25, then with that expected rate of return, a very conservative rate of return is 7%, right? You can expect more or less. But over the next 40 years or so, depending on when you retire, you're expected to make around this big number here. So that's pretty much what I wanted to go over to today. If you were to go with a 30-year mortgage rather than a conventional 15-year, sure, you're going to save, that difference in, slightly lower interest rate, but you're going to be missing out on this amount if you start investing now. And then if you really wanted to pay off your home, you can, and you have the flexibility to do so even when you're in a 30-year mortgage. So that's it. Let's get back to the video.
All right, so these are the pros to 15